Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Back, ladies and gentlemen, to the Family Banking Show. We're your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good. How are you guys doing?
Just got back from San Diego. And
yeah, how's that?
It's beautiful over there.
Yeah.
It's been a year since I moved from there into the sunny, at most times in the summer,
Not this year.
Minneapolis. But I miss it. But honestly, I'm so happy to be here in Minneapolis and be close to family and be experiencing all these seasons. But San Diego, obviously, people go there for vacation for a reason. The beach, Coronado, all those sights to see. It's just beautiful. So fun time though with the family.
Well, welcome back.
Yeah. And I think last time we had talked, it was near Father's Day. So this is being recorded towards the tail end of June now. But happy Father's Day if I didn't say it then.
Thanks. You too, Derek.
Thanks, guys.
And you.
All right. Well, this week, guys, we're continuing our series on Nelson Nash's book, Becoming Your Own Banker. This week, we're on page 19 and 20. And our topic of conversation is creating a bank like the ones you already know about. So what Nelson is attempting to do here is to draw the similarities between what an infinite banking type policy is and how it relates and correlates to a commercial bank. Guys, there's a couple of things just right off the bat that we need to draw our listeners' attentions to. And that would be that the first and most important thing to do when starting a bank is to study the business. What does Nelson mean by that? How are we trying or emulating that in our own practice of becoming our own bankers?
Yeah, that's actually a part I had highlighted is, you must first study the business so that you have a firm grip on what it's all about to feel that you can run such a business. And just when I read through that, I thought, that's what we're doing at the Family Banking Show. We're trying to coach people to show them, like I thought about this sentence. I thought about myself back when I first read this book, when that light bulb of the infinite banking concept was just starting to brighten. I was like, there's something here. Is it something I can do? It's like, I don't even know what it is. And I just know there's something here. And I feel like that's what we're coaching people to do is understand that you can do it. You can start your own family banking system based upon, dividend paying whole life, policies. And that helps our clients understand that they can do it, or your future clients that are watching this or listening to this right now, that you're in the right place, because we're going to help you understand that you can run your own personal banking, system. But you have to have that confidence. And the way you get that confidence is by researching, by reading, by learning, by listening. And so that's really what's trying to struck me there, is that's what we're doing here, is trying to help people gain that confidence so they can take the next step.
And I'll just say, it is totally worth the education, and you can do it. I learned this concept in the middle of having a younger than 1-year-old boy and a 2-year-old girl, and moving across the country, and tons of life events going on, and very little sleep and very little time. But this book is 90 pages, which is, I think, just a gift and just a grace of God, I think, to be able to reach those people like, where I was and honestly still am, who don't have a lot of time and can only dedicate, 20 minutes a week, even sometimes to reading, where you can discipline your week and just find that time that it takes to read this book, to listen to our podcast while you're driving or whatever it may be. I do not regret, setting aside that time so that, in the place of staying up late to watch Netflix or whatever it may be, that people normally spend their downtime. But I just want to emphasize, you can do it if you're busy, if life is crazy, and you feel like you don't have enough time. It's totally worth it to find that time.
Yep. Totally agree.
Good thoughts, guys. Yeah, one of the things that I think every person who steps into this space who wants to become their own banker and get a dividend paying life insurance policy like we're talking about, the concept or the idea is it's shrouded in mystery for whatever reason for people. At least initially, they're like, wait a minute, is this too good to be true? It's not. It's been around for well over 100 years, and people have been doing this. Some of the most wealthy people in the world have been doing this for decades, and a great way to transfer wealth to the next generation, which is what we love to focus about.
Mm-hmm.
So not only do we need to study the business, understand how a bank works, feel comfortable being able to run the business, knowledgeable in that sense, but Nelson says the next thing you need is you need money, you need capital to fund a bank.
Yep.
In a traditional sense, if we were to start our own commercial bank, how much money do you think we would need in order to do that?
A lot. He says 20 million here, but it's got to be higher now, don't you think?
Oh, definitely.
I would imagine that it's probably you're approaching 50 million plus probably to actually have a bank. I mean, just think about like real estate values in and around the metro where we are, guys. Of $300,000-$400,000 homes is almost entry level nowadays.
Yep.
So to be able to have a portfolio of loans like that, you're gonna need a sizable amount of capital to be able to write those loans out.
Yeah, he goes, kind of like this, the gist of this first part here is he talks about a real bank and just all the steps you have to go through to even consider to get that process started in real life. And then I highlighted in the middle, the bottom line is that you're going to spend a lot of time and money in this phase of creating your bank. And when I was, going through this section, so as you read this book and you'll becoming your own banker, you'll read it many times. You'll read it the very first time when you don't know what infinite banking is, and it'll start to just that light bulb will start to glow. And then you'll get educated, you'll research, you'll listen to podcasts and YouTubes like this one, or other infinite banking practitioners, authorized practitioners, people who are doing it right, in the infinite banking space. And then you'll start to build that confidence, and then you will reach out to one of us to start to get your first policy, your high cash value, permanent dividend paying whole life policy, to become that first bank that you create. And Nelson thinks of each policy you get as a business, as a bank. So you'll start your first bank, and then you reach out to one of us and you start it, and then you get to. Then you read the book again, and then this means different. It's kind of like it's like you read it through it, and it speaks to you differently each time, depending on what phase of your life you're in, or what phase of your education you're in terms of the infinite banking process. And then this was really like a kind of a comfort to me, is like it meant don't be afraid to capitalize. It's going to take some time. Get your policy started. Start paying your premium deposits. They're not payments, because you can just leverage that money right back again. And so you pay your premium deposits, and just don't be afraid to capitalize, and just, it's okay if it takes time, because a real life bank takes a lot of time before you can really start to leverage it, in your life. And so that this chapter really kind of gave me that peace of mind that, okay, it's okay if I just capitalize and I don't feel like I have to do something right away. Mm-hmm. To just give you that space to be patient. So that really resonated with me in this part.
The next section here, guys, that Nelson talks about is the way that banks work. Generally, a bank doesn't want to loan out their own capital that they use to start the bank. They would much rather prefer you and I and everybody else to deposit their money at their bank, and then they will utilize that amount that's on deposit to then loan out to people who need those loans. So just think about that. People depositing money in the bank then loans that out. When it comes to IBC and what we preach and teach is, think about who are those depositors. And as we've mentioned before, you have a captive audience, your family members, you personally would be a great depositor in your banking system and a great borrower potentially to your banking system as well. Guys, when Nelson talks about utilizing prudence and being wise and thinking about how banks fail when they over leverage themselves. What is the risk then to us as we have our own banking system? What do we need to keep in mind to make sure that we're being prudent with our banking systems?
I mean, this section and this description of over leveraging, and then we'll get to the case study that he gives of the Midland, Texas bank in 1983. I just think it's so revealing about banks, and to me, this is the first time I had ever been exposed to understanding kind of the background of how banks function, of how they are that profitable, and what exactly they do with my deposits. And he gives one example. It's not prudent to have $100,000 in reserves and lend out 50 million to, I think it says Brazil. And later on, they have $12 million in capital and they loan out 1.5 billion. Those are huge gaps, right? We don't want to fail as a family bank, right? It's yours, it's your family's, it's ideally going to last for generations to come. So you don't want to over leverage your own, I'm talking to myself. I don't want to over leverage what I do with my banking system. So if I'm going to take a loan, a policy loan from my hard-earned income that I stored in this whole life policy that's providing for my family, I don't want to do that foolishly. I don't want to do it hastily. I think that's also a good reason, or just a good thing, that it takes slightly longer than 10 seconds to get the money to appear in your account. Like, it takes just a little bit longer, and it gives you that extra time to think. And so paying back those loans is crucial, to be an honest banker. We'll talk about, to not steal the peas, to pay above whatever the interest rate that you're being charged, to make your own bank profitable, and to not expose your policy, your family bank, to potential failure. And we would never want that happen. I think in the industry they call it persistence, just keeping the policies in force. And that's primarily done by the biggest risk. Anybody who asks what's the biggest risk, it's you. It's the policy owner. It's me. It's human behavior, not treating the policy well, not treating your bank like a profitable business that it should be.
Mm-hmm.
Yeah, Nelson will go on to say and talk about the biggest risk, or the way to kill your banking business, is not being able to repay your loans on a regular basis, much less go above and beyond that to pay, retail rates instead of just what the insurance company is charging here. And so being prudent in that sense is, if you take out a loan, you must feel confident that you have the ability to repay that loan. Otherwise, don't do it.
Mm-hmm. Yeah.
It's no different than if you were to go to Wells Fargo or Bank of America, right? If they're not going to loan me the money because they know my income can't support it. Well, now I have to be the banker in that sense and set limits on my own self of what my income is at, and being able to service those loans. I'm not going to take out a huge loan if I don't have the ability to repay it.
Yeah. Good point.
Guys, as we move on here, let's talk about that case study there, the bank in Midland, Texas. John, why don't you go ahead and describe a little bit the context as to what was going on there for our listeners?
Yeah, this bank in Midland, Texas, it says it's the richest city in America per capita at the time. So you can assume, leading up to that time, they were doing very well. Particularly, and we'll get to this later, the directors, the board members, the executives at that bank. And so what it said is, in the book, is that they had a loan portfolio. I mean, outstanding loans were $1.5 billion, and over a quarter of that, 26%, were non-performing, meaning they weren't getting any of their money back. That is a huge deal. And then on top of that, it says that the losses in the stockholders' equity, they lost 87%, and their capital was then at 12 million. So, that's what I said just earlier, that they had this ratio of 12 million to $1.5 billion. I think about the nation's debt to GDP ratio. I think about
Wow.
personal DTIs. There's prudence. And we talked about this prudence. This is, and he talks about it in the paragraph, that it's a God-given law. There's no getting around it. There's no getting around just the wisdom that you can draw from looking at other failures in the past, and from just generally knowing that you're probably not supposed to loan out $1.5 billion when you only have 12 million. But in that case, um, just continuing on in the example, he asks, when the public found out about it, can you predict what happened to the bank deposits at this First National Bank at the time? That's right. They decreased by $500 million, right? So that makes obviously the bank in huge trouble. That's happened to many banks throughout history because they over leverage themselves. They lend out far more. And we'll get to this in further episodes in a much greater detail, because we as IBC practitioners and students of this, of the banking industry particularly, is we're going to talk about fractional reserve lending a lot more in future episodes. But just as a broad overview, a deposit of $1,000, he says, at your favorite bank gives them the permission slip to lend out 10,000. Right? They're creating money. They're lending out far more than they have in deposits. And no action that this First National Bank in Midland, Texas, was able to overcome the folly that they had already done, in the past, where they had over leveraged themselves. So they hired a new CEO. They tried to essentially damage control their situation, and that did not work out. And the bank ended up failing. And it shows that, it says, it was pretty evident that a lot of those non-performing loans, meaning the loans that were not being repaid, were made to the members of the board of directors. If you equate that to you and me and your own family bank, if you are not paying back your loan, you are essentially that board member who's not paying back. You're a non-performing loan. You're killing your business. And it says in this case that they had tried to chase these rates of return in the oil business, and when that crashed, they lost both their banking and oil businesses. So pretty tragic, example. We don't get excited about examples like this. We don't get excited about banks failing, because that really affects lots and lots of people, and can mean very hard times for people. But that's where the prudence comes in. That's where we can learn from others, and ideally never have to make those mistakes again.
Yeah, and then isn't it just like, this kind of comes full circle, basically, like what you just described, John? Don't steal the peas. Like that is the summary of this whole thing. You have the grocery store, you have the bank, you are the grocery store manager, you are the bank owner, you're the grocery store owner. Your product is peas, or your product is cash. Don't steal the peas, don't steal the cash. I think that he's basically saying that again in this example. He highlights here, had they repaid their loans plus interest, their bank would have still been in operation, but the God-made laws, greed prevailed and did them in, right? Human nature, fallen human nature will do you in. And so that's just that warning, and Nelson's warning us again here, do not steal the peas. You have this amazing system that is available to everybody, and almost nobody knows about it. If you can just be prudent and just run it prudently, it will bless your family and multiple other families. If you can just be prudent and fight against your human nature. And then he's saying that he also highlighted the banking system I'm going to tell you about. You can also destroy it by not obeying the basic rules of banking. So that's just, loans have to be paid back, or you can kill the best business in the world. It's up to you. So that's that reminder. It's on us, right? As bank owners, we have the blessing of the banker can do what he wants. He can do something good or he can do something bad, right? We have that freedom. That's the really great thing about having a banking system for your family using, dividend paying whole life. You have the control. You have the freedom. You can make your bank profitable, very profitable, or you can drive it into the ground. And so that's just the warning that Nelson is illustrating here.
Yeah, is there ever a time, guys, in your experience of becoming your own banker where you have regretted paying back a policy loan?
Mm-hmm. No.
Nope.
Won't know why?
Tell me.
The moment I pay that policy loan back, I have the cash available. I can just use it again. So I want to fill that tank right back up again because I can just keep on reusing it.
What a good reminder. What a good reminder for us as practitioners. If you've got an outstanding policy loan, you'll never regret paying that bad boy back. Because it just means that
I'm always looking for ways. Okay, what do I have anything coming up? Do I have a windfall coming up? Do I have some way I can generate some more cash to fill that, put more deposits in my bank? It's a different mindset. And our listeners, once you read, once that light bulb starts going off, you reach out to us. We set you up with a curated, crafted, specially correctly designed high cash value policy. Your mindset will change. You will start to run your own family banking system, and you will start to see things differently. So,
I want to point something out as well. A question I got today, actually talking to someone, is what is the cost? Is this expensive life insurance? Is this the question was centered around a comparison of term insurance, whole life, UL, all the different products out there. And I don't know about you, but I am not concerned with like the ratio of premium to death benefit when I know I'm going to capture that headwind of, the 345 miles per hour when I'm capturing this banking function and it's still generating this very significant death benefit. When we're talking about depositing in our own bank, we're not asking ourselves, well, that was an expensive insurance policy. I got to maybe scale back and not pay as much. No, it's how can I get as much of my money inside this policy?
I think people just don't realize you can just take it right back out again. I feel like they think it's gone forever.
Not a black hole.
It's that's like a huge light bulb for people. It's not gone. You pay your premium deposit. You can literally take it all out again. If you get to a point where you have enough cash value in there, you can pay your full premium deposit and the next day take it all back out and use it for something else. It's mind blowing. People don't think like that. That's changing the way you think.
Yeah, one of the other comments that Nelson makes here is that a traditional bank takes a long time before it could become profitable. And he even says, potentially as much as 10 years. Is that the same with a life insurance policy and designing it like we talk about when we're practicing infinite banking? Or how is it different?
Well, I'd say first off, I think this is if this is what you get, the most important thing is you are getting a death benefit. So the moment you pay your premium, if you walk out the door and get hit by a bus, that's the best investment you've ever made. The rate of return on that is astronomical. So just from the very first second you get your policy in force, that is an amazing investment in your family's, in taking care of your family if you happen to pass away. So like instantly you're getting benefit from the moment you get it. But the way we design these and the way we've been taught to design these is we minimize the death benefit on the front end and we maximize the cash value by using the paid up additions rider. So you're getting, so the cost for this kind of policy is lower because the commissions paid on policies are based on the base, and we're minimizing the base. So we're reducing the cost to our clients by designing it correctly, and we're maximizing their cash value. So we're designing it in such a way that it maximizes all the aspects of it so that you can leverage it to the best way possible from the get-go.
Yeah, this is truly a process and a concept that is most beneficial to the client, to the banker, to the policyholder. If we were just doing this to maximize our commissions and, just run away and make as much money as possible and go into the next person, that's not what we're doing. Like we are minimizing our commission to an extent. We're taking tons and tons of time to educate before even the first penny is spent or deposited, so that we know it's truly bringing value to you as it's done for us. We definitely believe in this because we do it ourselves. But, I think that the basis is education, and that we're not, just doing it for as much commission as possible, or pushy salesman type. We're all about just serving and blessing as many people as possible through the education and through the power that we see in this concept. So that was a good point, Rob.
Yeah, one parallel that I will make to the length of time that it takes for a traditional bank to become profitable, like Nelson said, 10 years, to when do you reach that magic point in your policy to where now all of a sudden you're really cooking?
Mm-hmm.
And that depends. It depends on age, depends on premium amount, it depends on the policy structure and design, as these guys have talked about here. Of course, there are levers that we can pull to try to make it as quickly as possible, to where now you're really cooking, as I say, as quickly as possible, but you're giving up something. There's always a trade-off. And this is life insurance, with any product, any tool, there's always going to be a pro and a con to any decision that you make. So whether you want to reach that point of profitability sooner, that's going to have impact on the policy structure and design over the long term. So like I said, there's always a trade-off, but it comes down to what our clients' goals are. And as these guys have said, we want to serve, we want to bless, and think 3, 4, 5 generations from now, and having a team of coaches like us that are here to serve and educate and to stay with you over those ideally 3 generations. I mean, and think about that as an advisor, being able to help somebody 2 or 3 generations from now. I get fired up about that. That sounds exciting.
What a blessing that is, right?
Yeah. Well, guys, as Nelson he's going to draw the parallel here. And of course, we've talked about this before in other podcast episodes. Instead of going out and creating a traditional bank, we're going to just utilize a structure that already exists. And that is dividend paying whole life insurance. And it's designed in such a way that it emulates exactly what banks are trying to do and what you would have to go through if you were to start a traditional bank. But we're going to get rid of all the gory mess, as Nelson calls it, get rid of the headaches and the hassle. Yep. Utilize a life insurance policy, a dividend paying, mutually owned whole life insurance policy for the purpose of becoming our own banker. And as Nelson has said other times, and we have mentioned, this is the most profitable thing you guys can do. Mm-hmm. Any other final remarks or comments for the listeners this week?
Yeah, I was just going to say that, Nelson, he talks about this particular type of dividend paying whole life insurance, and it's the way it's classified, the way it's named. And he says that it should be named something different, just as you name a plant or an animal, by its characteristics, by what you see as the primary, fundamental aspects of it, is how you name it. And for a dividend paying whole life insurance, it really does mirror all that a banking operation can serve for a policyholder, with death benefit on the side. That's also really significant and really important for a lot of families. So he would probably venture to say, and I think he has said it in the past, that really these policies should be called your own personal bank with some death benefit on the side. So I think that's just a really, clear way of pointing out the features and the primary aspects that's included in these policies.
Yeah, well said.
All right, guys. Well, in the next episode, we're going to be talking a little bit more about that dividend paying whole life insurance and how we create our own system. I'm looking forward to it, guys, and I hope our listeners are as well. If you've enjoyed this episode, I would encourage you to click subscribe or like and follow, do whatever it is, send it to your family and friends. Help us reach more and more people because we're here to serve and bless, as we've talked about in this episode. Guys, until then, we'll see you in the next episode.
Sounds good, guys. Take care.
Thanks.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.